Is this okay?
Great, thank you very much. I want to commend Santander for this wonderful title because I think it most certainly is apt. Europe needs faster growth. It needs capital formation. It needs to focus on supply side growth, and they need to do it now. Fortunately, we have a representative from the United States government, the Federal Reserve. There's a very different mindset in the United States right now. Washington, the wheels are turning with energy and enthusiasm for economic growth, for supply-side policies, for deregulation, for capital formation. You can feel it in the streets of Washington. You can feel it in the streets of Main Street. You're spending a lot of time out across the country. The world is watching, and the United States is moving ahead at a rapid pace. You may not like the politics. You may not like some of the externalities, but the U.S. is moving, and Europe is going to need to move fast or they're going to be left behind. We're going to talk about this in a number of issues today with the Vice Chair of the Federal Reserve, Mickey Bowman, who's a seasoned central bank governor. You've been at the Fed now for 7 years.
7 years.
But you've been in a very important spot now for several months, really leading this revolutionary change in the U.S. I do not think deregulation is a dirty word. I think we should all embrace it globally. And we see it not only in the financial services industry, but so many other industries. But financial services, the mindset has changed, the mood has changed. You have brought really a whole new approach, and that is pragmatism, a sense of cost-benefit analysis, right-sizing. We had 15 years of constantly adding on capital and liquidity and focusing on operational risk. The time has come to rethink this. Tell me about your philosophy as you take on this job.
Well, thank you very much, Tim. And it's really exciting to be able to be a part of this event today where we are talking about growth. It is the common theme of all of the conversations that we're talking about around the world, about how important it is that our businesses are able to be competitive, to engage in a way that is helpful to the bottom line of the economy in whatever country they're based in. In the United States, I think one of the ways that we're looking at this, and I don't like to use the word deregulation because I prefer to say modernization. One of the things that I've been talking about for a number of years at the Federal Reserve Board, and it's helpful for you to know that my background is in banking. It's not just in banking, but I also served as the state bank commissioner in the state of Kansas before I came to the board and brought that experience to the work that we do with our state member banks at the Federal Reserve. So I've been talking for a number of years about the importance of making sure that we have the appropriate level and scrutiny of regulation and supervision for the appropriate risk, complexity, and size of a financial institution. That concept in the United States is something that we call tailoring. And we have banks that range in size from $5 million in assets to obviously multiple trillions of dollars in assets. And it's pretty it's not logical to think that you would apply the same regulations to the largest banks that you would to the smallest banks. So that's something that we've been talking about for a long time, is making sure that when we're thinking about the regulatory environment and our framework, that we're not keeping those smallest institutions and the smaller institutions from being able to serve their unique customers, their unique geographies, and their unique economies to ensure that they are able to facilitate growth in the way that banks are supposed to do that. So as I started this role in June of this year, and for several years prior, as we were looking under different leadership to think about implementing things like the Basel regulation and things of that nature, the way that I think we should be approaching regulation and the way that I'm approaching it now is from a pragmatic, a very practical approach. What's the implication of if we calibrate something a particular way, what's the downstream effect? What industry is going to be affected by that, and what other business services won't be able to be offered because the calibration affects whether or not it's a profitable business line anymore? So that's sort of the way that I've been thinking about it, and really from a 15-year past past the financial crisis perspective, looking backwards. And it's very important, a lot of the improvements that were put in place post-financial crisis, but I think in 15 years, the economy has changed tremendously. I think we've seen a number of different innovations and different engagements that I think our banks in particular would like to be a part of, but they're inhibited from doing so because of the regulatory environment and things that we may have created or calibrated back during the post-financial crisis years may or may not be still fit for purpose. So those are things that we're looking at to try to make sure that when we're looking forward, we're allowing for what the future will bring, and that banks can engage in ways that can be meaningful for growth and for their businesses that they want to continue to serve.
You have an ambitious agenda. You've got a lot going on. You have a regulatory approach, and then we'll talk about supervisory aspects as well. On just strict regulation, capital, liquidity, there's a whole host of items you're looking at. Maybe just give us a quick review of what those items are and where you are in the process.
Since we had a number of things that had yet to be completed from the last administration, one of those, of course, was Basel, and every other country in the world has completed their Basel rule, and they're waiting for us to implement theirs. So that's one of the priorities that we have. But we can't look at capital in a vacuum. You have to look at it in terms of all of the pieces of capital that aggregate into whatever the capital levels are that we're expecting our banks to be able to hold to maintain safety and soundness. So in addition to the Basel framework, we're looking at our GSIB, GSIB analysis. We've also just passed a recent proposal to change our stress testing models and how that will be implemented in the future. We have a supplemental leverage ratio rule that will allow banks to continue to intermediate in the treasury markets. As we all know, the fiscal situations in many countries is such that more and more issuance is happening, and we want to make sure that our banks are positioned well to be able to intermediate in that market. So it's Basel, GSIB, stress testing, and SLR. Those are the 4 pillars of just the capital regulations. So the other focus that I have is on supervision. Over the past few years, again, since the financial crisis, we've really been focusing on things that are procedural in nature, box checking. Do you have the right documentation? Right. Those kinds of things. And while they are important, they're not as important as things that actually lead to a bank's failure, like material financial risk, as we saw with Silicon Valley Bank. So these are the things that we're refocusing our supervisory activities to ensure that we're accounting for in the appropriate way. So one of the first things that I did when I came in addition to introducing the SLR rule, was to reform our framework for our large banks and large bank holding companies to ensure that we're not allowing things like governance and control issues to dictate what the condition of a bank is. Right now, before we talked about implementing this rule, which we're about to finalize, we had 2/3 of the largest institutions in not well-managed condition because of a single rating decline in governance and controls. Right. And I don't think that that's reflective overall of, one, the financial system, but also, two, it's not reflective of a fair framework that represents those things that actually lead to a bank's failure.
Well, you've inspired us. We just did a cross-jurisdictional study of supervisory practices around the world based on your inspiration, and what we found is something very similar. Many jurisdictions are moving in your direction. There is one jurisdiction which is not, which seems very wedded in the current structure. I think that will change, hopefully, over time. But as you look over the horizon, this is an ambitious agenda. What comes next once you've got beyond these really important macro changes?
So what comes next on the regulatory agenda? Yes. Well, I have to make it through it first.
Yeah.
So we have a number of things that are focused on smaller institutions. Obviously, I had to get through the largest bank program before we could really expand and move on to that. But we're also looking at things like ensuring that there's an availability and a method for identifying and mitigating fraud. We have a lot of fraud in the United States, and that leads me to making sure that we have room for innovation. Right. One of the things recently, we had a conference at the board where we invited Sam Altman with OpenAI to come and do a fireside chat with me. We talked about a number of different things, and everyone thought, why are you talking about AI at a capital conference? But the point is that we need to be thinking about the future. We need to understand how AI can help banks and other businesses compete and function in a new environment. So that's one of the ways that one of the things we discussed was, how do you think about fraud in a world of AI where people can easily go around or fool the systems that you may put in place, especially for biometrics or dual authentication or things like that. So we're working, behind the scenes on trying to identify ways that both supervisors and banks can engage in safe and sound ways to integrate AI. And then the next thing, of course, is digital assets,
right,
because the Genius Act recently was passed in the United States. So we're tasked at the Federal Reserve with creating a framework for the issuance of, for issuers 10 billion and below. And so we're working on that. But in parallel with that, I think it's critically important, as your last panel was noting, that banks are able to engage fully in these digital assets if they want to, because we want to make sure that they're not left behind. But we also want to make sure that they're engaging in a way that separates those digital assets on their balance sheet from their regular business activities, so that we can ensure that the safety and soundness remains, but that they can also offer those kinds of services that their customers may want.
So your view is we need to ensure that banks can compete with
Absolutely.
non-bank institutions in this really emerging fields of technology with stable coins or other forms of digital assets or currencies.
Absolutely.
But there are Basel risk weights which make that prohibitively costly now. Our effort is to try to change that.
So we're not adopting those Basel risk weights in the United States. It's a purely Basel. I don't think anyone actually has adopted those risk weights, and they're actually not very realistic.
Correct. They're supposed to go into effect January, I think. We certainly have been, and with Greg and others, have been very vocal about changing those risk weights so that our institutions can compete.
Well, and I think that's the point that I was making earlier, is that I've been on the board for 7 years. I have seen how all of this regulation has evolved to be more and more complex, and then to add more and more onto the expectations and the frameworks and the costs of compliance. Now it's time for us to really think about what's reality.
Right.
What do banks need to be able to engage in, and what does the future look like? And if it's digital assets, they need to be able to do that, and it can't be risk weighted at 1,250%.
Correct.
It's just not realistic.
You also wear the hat at the FSB. I know you've got a call shortly.
I do.
So you play a global role in addition to the U.S. role. What are your ambitions for your role in that organization, given its history and given its agenda over the last few years?
Yeah. Well, it's exciting to be able to be, when I was appointed and confirmed for this role, I was made the FSB, the U.S. plenary member for the FSB, and also was recently designated as the chair for the Supervision and Regulation Committee. So my agenda for the committee is modernization of regulation, because all of the governments around the world, or the majority of the governments around the world, are really talking about the importance of growth and controlling the amount of regulation that exists and updating that regulation to ensure that it allows businesses and the economy to continue to grow. So that's one part of the agenda, and that's evidenced by the Draghi report,
right,
by safe and smart regulation in the UK, and a number of other initiatives around the world, and in Asia as well. So I think so that's one part, the modernization, but AI is a very important part of how we think that banks are going to be engaging going forward, whether that's internally or externally, and it's an important thing that we need to make sure we understand and how it might be used.
And speaking of AI, how do you see it from the macro side? There are lots of discussions about an existential threat to big swaths of U.S. employment or other countries' employments. Whole careers, job categories will be disappeared overnight. How do you see it from the macro demand side?
Well, that's a really interesting thought process, and I think a number of people think that it will have an immediate impact on the labor market. I don't know that we're seeing an immediacy of the lack of jobs in the labor market. What we've been seeing, and I've talked about this a lot in my views on our monetary policy positioning, that we're seeing a labor market that appears to be increasingly fragile. But in my mind, this is a holdover from the COVID area where it was very difficult for businesses to hire enough skilled workforce.
Right.
So they overhired at that time.
Labor hoarding.
Exactly, labor hoarding, we also call it, and now there's job hugging because people don't want to leave their roles, and so it's kind of the great wait is another thing that folks are calling it in the industry. But I think we're seeing still a holdover of the fact that businesses don't want to let their employees go, although we're starting to hear a little bit more about layoffs. Hopefully that won't become a bigger issue, but it's something we're continuing to watch. But most of the job openings, and speaking with some of the online social networks and business openings providers, job openings providers, they're talking about most of the openings being related to AI. So I don't think that there won't be jobs. I think that the jobs will change in some way that requires you to understand how to utilize AI in a way that's beneficial to the organization that you'll be working for.
Right. Jobs are composed of multiple tasks. Some of those tasks will be obsolete, some will be enhanced. So you have to think about tasks, not necessarily individual jobs.
Right, it's a shift, I think. And we saw shifts like this with the invention of the internet, and the more we continue to adopt the automation of different technologies, whether it was in the industrial age or otherwise. It's just another shift, I think, in the way we'll be operating and businesses will be operating going forward.
You have a dual mandate as you weigh jobs, employment versus inflation. Where are you on that spectrum? What worries you most?
So our dual employment is maximum employment and stable prices. So we've come from, again, a COVID period where we had inflation that was as high as 9% at that time. So my perspective is pretty reasonable and thoughtful about how we've seen a significant decline in inflation over the past few years. And now the most recent readings indicate to us that our goal is 2%, but if you look through tariff effects, which we estimate to be about 0.5%, the measure that the Federal Reserve likes to use is core PCE, and that's about 2.3%, which is not very far from our target. In fact, we were thinking when we changed our monetary policy decision framework when inflation was below our target by 1.5.
Right.
So I think we're within a very close range of our target. So I'm pretty confident that whatever effects we'll see on inflation, especially if they're related to tariffs, will be temporary and that they'll essentially be, we can look through them because it's a one-time price effect. With the labor market, I'm a little bit more concerned. Over the last few months, of course, the data hasn't been officially provided to us through our Bureau of Labor Statistics because of the government being shut down. But what we've seen through April, the 4 months preceding August, is a 25,000 jobs created per month. That's nowhere close to break even. We think that September, based on some of the payroll data that we get from the private sector, was negative job growth. So I think that's where I'm focusing my concern. And when I'm advocating for a rate cut, it's because I see an erosion, a potential fragility in the labor market that could continue based on the data that we're seeing and the discussions that I have with a number of contacts around the country about their hiring practices and thoughts about how that's going to evolve going forward. So
we had a discussion last night about growth, and just in the last minute, and I went back and did a little, I couldn't sleep, it was jet lagged, I did a little back of the envelope math. I went back to 1972 when the Club of Rome put out its Limits to Growth report, which basically said the world has come to an end, the US can't grow anymore, we had high inflation, high interest rates. You know, it was thought that the exceptionalism of the United States is done. Since that report came out, the United States economy has grown by almost fivefold. GDP per capita is up 150%. We've created a net 116 million jobs, and labor intensity has dropped by 50%. At the same time, inflation came down over time. Growth is achievable if you have the right policies in place, and you can do it in a non-inflationary manner.
I firmly believe that if you have the right regulatory frameworks in place to allow for businesses to do the work that they need to do to support the economy and themselves and to hire people, that everything will continue to grow and that will be just fine.
I'll put an exclamation point at the end of that. Ladies and gentlemen, Michelle Bowman.
Thank you. Thank you. Thank you, Steve.